In this episode of Smart Humans, we talk with Bob Elliott, founder and CEO of Unlimited. From his background as a classically trained botanist to eventually becoming a macroeconomist, and now an entrepreneur wrapping hedge fund strategies into a public wrapper ETF. He gives us his point of view on the market, where we headed with recession, the tariffs, and of course, his strong point of view on gold and how it could diversify your portfolio.
Welcome to Smart Humans with Slava Rubin, presented by Vincent. In this alt investing podcast, Slava talks to amazing minds about their investment journey and finds out what it takes to make it in the markets. And now, here's your host and smart human, Slava Rubin.
I am excited to tell you all about Air Insider, the private market investor's unfair advantage. Every week, you get public and private market investment picks from industry experts like Jason Calacanis, Anthony Scaramucci, and of course me. You'll get access to exclusive monthly briefings as well. Right now, we're offering the first year at 50% off, which is less than $10 per month. We've also partnered with some of the best investment platforms and tools and gotten our members thousands of dollars of offers and discounts. This includes $50 off of free stock from Public, up to $250 of free investment credit from Percent, and up to $1,000 of free gold from Argo, and a whole lot more. All of this for just under $10 per month. You can sign up at withvincent.com/insider. Again, that's withvincent.com/insider. Invest like an insider. Hello, and welcome to the latest episode of Smart Humans. I am super excited for today's guest. We have Bob Elliott, who's founder and CEO of Unlimited. Bob, welcome.
Thank you so much for having me. I appreciate at least making a run at being called a smart human. I'll let folks determine whether that's true by the end of this.
Exactly. You have 30 minutes plus minus to let the jury decide. But we were super excited to have you here. I mean, you're innovating in fintech. Obviously a great investor, and we'll explore all of that in just a minute. But we always like to get started with the beginning, which is tell us the background. What was it in your youth, in your college days, in your work days? How did you navigate to get where you are today?
Yeah, I mean, I've been a systematic investor, particularly from a macro perspective, for a couple of decades. But the route to get there was a bit unusual relative to many folks. I don't think if you had told me at 15 or something like that I was going to be doing this, I would have believed you. For most of my sort of younger days, I was really into the hard sciences, botany in particular, which is, you don't find too many what I like to describe as classically trained botanists out there in the world. But that's where where my academic training was. I also spent a fair amount of time in working on issues related to public health back in the early 2000s, particularly related to the HIV and AIDS epidemic. And particularly it was with that work that I sort of increasingly realized that, the big drivers of health outcomes and frankly, human experience outcomes comes down to what happens with the economy and with the macroeconomy. And so that started to get me interested in thinking about exploring, macroeconomics as a career. And I ended up starting at Bridgewater Associates, which is, I think, still the world's largest hedge fund, but certainly at the time that I left about 7 years ago, it was. And my basic idea, they are sort of well known for hiring people who don't have pure economics or business or finance experience. And so I thought it was going to be a great place to kind of go, get paid decently, work for a couple of years, and learn a little something about macro. And the reality is I sort of fell in love with macroeconomic investing and systematic investing as being really, I think in a lot of ways, like an incredibly challenging puzzle to understand every single day. So, you don't just become great at it. You constantly get new learning and new experiences. And then also because I think it informs how the world works. You see everything around you is essentially driven by macroeconomic dynamics. And so in the same way, a physicist must love seeing the movement of matter in the world and understanding that, so too do I see the sort of movement of everyone in an economic reality.
Nice. You are right. Yeah, it's not always that I hear botany as part of my conversation on smart humans. So we need to explore that further. How did you fall in love with that? And what does it mean that you're a classically trained botanist? And then obviously the next thing is, what do you do with that today? Anything?
Yeah, well, so my botany career, back many years ago, well, my father grew up in a farming town, and so we were very active gardeners.
Where
And
was this? Where was this?
this was in Michigan,
Okay, great.
and and so I sort of fell in love with gardening and growing things and things like that as a small kid. And when it came to, while all the kids were like looking at camps to, I don't know, go play dodgeball and stuff like that, I was interested in nerd camps that let you learn more about sciences. And it's hard to believe, in the world you always want to have some edge, right? You want to explore the thing that few people are interested in exploring. I know it's hard to believe, but botany was really not a hot topic in the 90s for kids to go to summer camp to explore. But I did a couple of different National Science Foundation things and things like that, research at various institutions that I was able to do because there were few other people who were interested. But it was great. It was great. It was, I mean, I find botany to be very fascinating. It's like a kind of an incredible field where it is so central. Plant sciences is central to our day-to-day lives, but there is so much that is not understood from a micro perspective in terms of plant biology, but also from a macro perspective. And so that's when I say a classically trained botanist. A lot of my work was in what's called systematics, which is how do the various elements of plants develop and interact together, and how are they stressed in certain environmental conditions. And so, your listeners probably remember xylem and phloem and things like that. I spent a lot of time exploring that, looking at that, and imaging it with some of the original imaging software and technology related to that to understand how it all went together. And I like to sort of joke, like the conclusion was, after many, many years of research as an undergraduate, my conclusion was that plants like water, which is good. It's a good thing to know. So that's poking fun at me. But I love the plant sciences. And honestly, in a lot of ways, the sciences, in order to be great at markets, you have to have non-consensus views. And in order to have non-consensus views, you can't have the same perspective as the thousands of finance professionals, undergraduates that come out. And so I've often found, amongst all sorts of people involved in markets, that people who come from the pure sciences are uniquely positioned because the sort of systematic, rigorous, quantitative sort of way of thinking is so elemental to how you might approach, thinking about trading markets.
You have such a diverse background, the botany, the farming, the public health, macros. Is that you just always trying to be curious, or where does that come from?
Yeah, I think I've never been all that good at just doing one thing. I've always kept a curious mind and sort of, I think I was never the person who was like, I am going to be X and I will do whatever it takes in my whole life to do that one thing. And instead, sort of let my curiosity and interest, guide me in terms of what was going on, in terms of where I was exploring it, and also recognize that at some point, I like, with the plant sciences, I realized I didn't want to be like in the basement of the biological laboratories for 40 years, So I was like, nope, that's not going to be a long-term career, but it was great while it lasted and a key element of how things developed. And I think, I don't know, why do people operate this sort of way? I think in some ways it's probably genetic. I mean, my father was an entrepreneur and essentially had businesses, everything from copy and fax machines to golfing equipment, like all sorts of different stuff. And probably that's my exploration, or my interest in a bunch of different fields is kind of similar to that.
All right, great. Well, you were at Bridgewater before. Now you're an entrepreneur and obviously a strong investor, and you were a strong investor back at Bridgewater. We'd love to know how you invest your own money. So obviously, a big slug of your net worth is going to be your own company and your equity in that. But let's just put that aside. So how do you like to invest your own personal net worth in terms of, the audience knows there's the classic 60-40-0, which is 60 public equities, 40 bonds, and 0 into private alternative investments, i.e. crypto, real estate, private credit, art, collectibles, pre-IPO. How do you think about that 60-40-0? Are you 60-40-0 or are you some other percentage?
Yeah, from my perspective, having not only been in the public markets for a few decades, and then also having deeply studied market and investment outcomes, over courses of, across many countries over hundreds of years, for me, it's sort of the key thing in creating what I call a strategic portfolio, right? Your savings portfolio. This isn't your speculation portfolio. You could take some of your capital and go speculate as you want. That's kind of the fun money right there. But when you're talking about your core savings portfolio, the key thing you want to hold is you want to be diversified. And that diversification is critical because you don't know when you actually need the money. And I think a lot of people, people who have sort of started investing in the last 15 years, who have basically seen like 12 weeks of drawdowns in their portfolios in the last 15 years, don't understand that you could be in a situation like 2009 where, your equity portfolio is down 2/3, or back in, 2002 where your equity portfolio was down similarly, or through that period where you essentially had zero equity returns for 15 years. And so I think that, I think there really is a distinction between those people who started investing and saving after the financial crisis and those people who did, because the people who did had the scars of how things can turn out and how the world operated before the financial crisis, and those scars are much more indicative of the wide range of plausible outcomes. And so I have something I call the simple game plan, which is just essentially a balanced portfolio, about 80% of it passive, meaning, investing in a diverse set of long-term, a diverse set of securities like stocks and bonds and commodities, gold, et cetera. And then about 20% of my allocation in that simple game plan portfolio is to diversified alpha strategies, meaning public market strategies where you can take advantage of, long and short positions to generate alpha that's on top of, just normal market returns.
So do you have no alternatives like crypto, pre-IPO venture, real estate, private credit, art, collectibles?
In general, as a sort of my experience is much more in the public markets, and so in general, for a strategic savings portfolio, I don't hold a lot of illiquid assets or investments. I have a very, very small portion of capital supporting some former colleagues who work on boring businesses with good cash flows, but that's more support for what they're up to, and
that's like sub 5% of the net worth sort of thing.
Yeah. That's more. Very little illiquids, and part of the reason why that is because I think while illiquids I think are often look to be very attractive, and often have very good stories, I think there's a lot of challenges with them. I mean, first of all, the illiquidity is a real challenge, which is you never know when you need your money, and so if you invest in a venture fund, like who knows when you get your money back, right? It could be 10 years, it could be never, it's quite challenging. And that's hard for even an institutional time frame, that's painful, but for an individual time frame, that's not really reasonable. And I think the other element of it, another element is in almost all cases, those illiquids, the fees are way too high to justify the returns over time, particularly relative to the types of things that you can get in the public markets. And so if you can get better liquidity terms, lower fees, and similar diversification and returns in the public markets, then why shouldn't you invest in the public markets rather than concentrate yourself in the public markets rather than go out and try and pick specific illiquids?
What about Bitcoin?
I don't hold any Bitcoin and never have. I was actually responsible for Bridgewater's look at Bitcoin because I headed up the foreign exchange business there. And the core reason behind that is that as a macro investor, first thing I'd say is you don't have to invest in everything. And when you look at something like Bitcoin, it's not really driven by the traditional macroeconomic dynamics that, asset classes like bonds or gold or stocks or industrial commodities are driven by. And so therefore, it's a very highly idiosyncratic asset that may or may not have a positive expected return. Obviously, it's done well. Doesn't mean, from a forward-looking perspective, who knows? But without really having a good understanding of its macroeconomic drivers, it's difficult to position it in the context of a portfolio. And I think even what we've seen in the last year or two, 5 years, like you're still not getting traditional macroeconomic drivers. It is not digital gold. It is not a short position in the US dollar. It is not a inflation hedge. It's none of those things. It is an idiosyncratic asset. And it's much more akin to, I'd say, the type of return profile that would exist with like a venture style investment than it is, a single company venture style investment than it is in sort of a macroeconomic, a macro diversified portfolio. And what I also say is a lot of people look at it and say, well, the returns have been high. You can't get high returns. Like, you can always target your return profile to be whatever you want. You could dial that up or dial it down. There's not a lot of people who are good with 85% drawdowns and 75% annualized volatility. Basically, no one does that. And so presuming that you're looking for, a volatility in your portfolio that's something like akin to stocks, there's no reason why you can't just invest in a diversified set of macro assets and get equity-like returns.
Which equities would you invest into to try to get Bitcoin-like returns?
Well, I'm saying you're not going to the challenge with investing in something like Bitcoin is the volatility is too high for people to be able to stomach as an investment alone, right? And so what I'm saying is, in general, people's risk tolerances, and I'm saying, having talked to hundreds, thousands of advisors, lots of people, in general, people have an equity-like return, equity-like risk is about the extreme of what people are able to handle and still stick with their game plan. Right.
Got it.
And so as a result, if you invest, for instance, in equities, gold, long-term bonds, and diversified commodities, along with let's say some diversified alpha strategies, you can get equity-like return profile that's a lot more consistent and with fewer drawdowns than what you get just investing directly in equities or essentially investing in, having some of your portfolio in Bitcoin.
So just to pull this thread a little bit further, so you still today have 0 Bitcoin, is that right?
That's correct.
So are you like a naysayer, 100% never going to have it, or are you open-minded to having it?
I'm not. What I'd say is, when you trade markets for a living, you recognize that there are certain instances where you have edge in understanding a thing, an asset in particular. And there's times when you don't, and you don't have to trade every market. You don't have to invest in every market. You don't have to trade every market.
Very Buffett style.
And so if I felt like I either could effectively contextualize the expected return of the asset in the context of macroeconomic dynamics, so in part, in order to think about how to put it into a diversified portfolio, then I might consider it from a strategic perspective. Or if I felt like I had an edge in determining its tactical price movements, which I think there's many, many people out there that have way more edge, way more understanding of everything that's going on in Bitcoin or other cryptocurrencies, then I would be interested in trading it from an alpha perspective. But at this point, it doesn't check either box, and it's not particularly important in terms of creating a long-term strategic diversified portfolio. I mean, just as an example, like people talk about Bitcoin going up by 2x recently, gold's gone up by 2x recently, right? Like there's no, you don't need, they're both fine. Like you don't have to do everything.
So just to be a bit provocative, and then we'll move on. So in terms of macro, I think Bitcoin's interesting because I do think it is kind of like digital gold. And if you think about it as gold, typically when analog to digital, whether it's movies or a lot of different industries, usually the digital market gets to about 2x the size of the analog market over time. And if you think about it, very round numbers, gold being like 20 trillion, you could really look at like a $40 trillion dollar market. If you look at it as like a $40 trillion market with 21 million Bitcoin, you're looking at potentially, at its, market, like, equilibrium, at like potentially $2 million Bitcoin, right? Now, obviously it's at 100,000 today. It was a lot less before, and it could go up and down a lot. I like to get people to think about, maybe put in 2% of your net worth into it, because if you're walking down the street and you lost 2 cents out of your dollar, you probably wouldn't really notice it and really not impact how much water or soda you're going to buy that day or how many cookies you're going to buy. But there's a decent chance that it's going to 10x in the next 20 years, if not many more x, which can obviously have a huge impact on the net portfolio. Anyway, you don't need to debate with that, but it's just a perspective where I do think at a macro it fits and it can diversify quite interesting. Go ahead.
I was going to say, I don't have I don't have a particularly strong view on what you just said. That may be the case. It may not. I think the 2 points that I'd emphasize on it are, one, it is not trading like digital gold. In fact, the two are trading at essentially a zero correlation. That's an important thing to consider.
You mean in terms of the volatility, you mean?
In terms of the price movements of gold versus Bitcoin, they're trading as a zero correlate. They're zero correlated to each other, and so instead it looks like Bitcoin has a lot of idiosyncrasies, but if anything, it looks more like a risk asset, meaning like more like a equity like asset than it does like gold. And the reality is, like, there's plenty of equity assets out there, meaning like you get the whole gamut of all the equity assets in the world. So it's not clear that it's necessarily diversifying if it actually is trading, if it is actually a risk asset. Even there, it's a little bit of a question. And then on the gold side, like, I hear you in terms of the 1 or 2%. What I'd emphasize is that the vast majority of investors also aren't considering gold. In fact, if you look, something like 98% of investors have literally zero gold in their portfolio, which is kind of crazy for an asset that has beaten the S&P 500 with a similar risk profile over the last 25 years and has a 5,000-year track record of maintaining its storehold of wealth in a macro environment where monetary debasement is sort of the government policy du jour, and will be for many decades to come, given the over indebtedness. And so, for me, at least, the case for gold is certainly independently compelling and has sort of the similar vibe of, how could you not invest in something with that sort of return, diversification and return profile, and that creates a lot of possible upside for gold as well.
Awesome. Well, you were talking about the macro, and that's actually our next question, which is, you're the perfect person to discuss, where are we in the current market situation? Everything from inflation to rates to stock market to job market to the economy to obviously, administration, tariffs. There's so many things going on. We love to hear from our guests, and you, of all people, are the perfect guest to give us an opinion as to where we are today, where we headed in the next 6 to 12 months. Obviously, this is not financial advice. We'd love to hear your opinion.
Yeah, I think this is one of the more interesting times from a macro perspective, both because macro and policy is driving most asset returns significantly, and at the same time, there's more uncertainty than has existed in particularly the policy environment than we've had in a long time. And so, from my perspective, the sort of big outstanding question, I should say, absent the administration, we're basically actually in a pretty good economic environment. Growth's pretty strong. Central banks are easing. They're actually easing in global central banks have eased and are expected to continue to ease in an environment where growth is okay. And part of the reason why that is because inflation globally has receded, which has been given those central banks the ability to ease in response. And so if we didn't have an administration, a policy question in front of us, we'd be looking at a late cycle environment with a easing impulse, the global coordinated easing impulse on both the fiscal and the monetary, which would typically be good for stocks and gold. And so that's kind of like that's the baseline backdrop. Now, on that backdrop is, and I should say up until really the beginning of this year, a lot of what we saw for the previous couple years was sort of consistent with that general dynamic. Growth's pretty good. If anything, markets were too worried relative to those sets of conditions, and that continued easing was supportive to asset prices, stocks and gold, et cetera. The administration really throws a wrench into this whole thing, because what is going on is basically an exogenous set of negative growth policies that are likely being pursued by the administration. The real question is, there's a big question about the magnitude of those, but the direction is pretty clear, which is that restricting immigration is a meaningful drag on economic conditions, as much as 1% of real growth. And pursuing the tariff policy can, hard to know. And, if we recorded this tomorrow, we might have a different story in terms of exactly what the tariff policy in place is. But, we were looking at a drag on growth somewhere between sort of 0.5% in the best case scenario and almost as high as 2% in the max impact scenario. Those are pretty big drags on economic conditions. And so if they are, the immigration one almost certainly seems like it's going to happen. I mean, is happening and seems like it will persist. The tariff one is the big question, and there's a lot of ambiguity there, but sort of every day that the tariff dynamic continues to be in place, and at least right now, it looks like something like 15% tariffs are going to be in place for the period of time in which they deal with the IEPA judicial ruling, and then possibly for longer than that if the administration gets ruled against and then implements Section 122 tariffs, which allows them to have 15% tariffs for up to 150 days. So it looks like roughly that 15% level is in place right now. That is big enough to create a sufficient drag on the economic conditions and investment that could start to meaningfully slow the economy and create real weakness. And that's coming at a time when asset prices, particularly stocks and equity indices, are not really pricing that in. You look at stocks, you look at bonds, the way the yields, current yields, are all pricing a very, very strong growth scenario. And so it's not certain that we'll go through a weaker growth scenario, but the policy mix looks like a weakening impulse, and the asset pricing in the market right now looks like it's pricing in quite strong growth. And that's sort of, it looks basically like the skew of the possible outcomes are skewed more negative than the pricing, which is, gives you a moderate confidence trade in, from a macroeconomic perspective.
So hearing you on the other side here, are you short the market today? Like, do you think it'll go down?
Sorry, say that one more time.
Just listening to you here, it sounds like you think the potentials are leaning negative as opposed to positive for like the stock market. Like, yep. Are you mentally short, thinking it's going to go down?
Yeah. So I think the way I describe this is I think the two or three trades that seem most compelling are bonds are looking attractive relative to stocks, which is a weakening growth. Bond yields, particularly long end bond yields, are basically at cyclical highs, at 25-year highs. And equity prices are at 25-year, are at highs essentially, right? And so bonds look attractive relative to stocks in that environment. Gold looks attractive given the uncertainty environment that continues to persist, particularly relative to stocks. And international assets look compelling relative to U.S. assets from a combination of the fact that those jurisdictions have more room to ease because they are dealing with less strong economies. Their valuations are lower, and they've been a big source of capital flowing into the U.S. economy and into U.S. assets. And as these conflicts have emerged, we've started to see signs in which those foreign investors, which are super overweight U.S. assets, have started to repatriate capital and support their own domestic asset markets. And so a view that is bullish on those foreign equity markets, say relative to the U.S. markets, would also be appropriate in this sort of circumstance.
Some more opinions from you. So recession or no recession coming up?
Well, it's one of these things where what is going to be the tariff dynamic that's in place, right? If you have 15% tariffs, we'll probably have a meaningful slowdown. If you have 25% tariffs, we'll have a recession. If you have 0% tariffs, things will be good. I think that's one of the challenges, is having to navigate such a policy uncertainty, right? That's very unusual, I would say, having been doing this for a couple of decades, where you would have that wide a range of policy outcomes. The thing I'd emphasize, a macro investor by sort of trade is always thinking about a wide range of different possibilities, is that what is priced into markets currently, particularly how stocks are priced relative to bonds, is essentially near certainty that there will be a strong economic environment. And so any disappointment relative to that strong economic environment should favor bonds relative to stocks. Do we get into a recession or not? Not to be sort of antagonistic, but it's not really an interesting question. The question is more, will economic outcomes be weaker than what is currently priced in? That is something that you can sort of say with more confidence than recession or not, which, is a little bit a magnitudes question, let's say.
What do you think is going to happen with the Fed in terms of the rates? Were you predicting that? Obviously, these are all moving targets and hard to predict, but
yeah. I mean,
that's why we have guests like you on the show.
That's right. The Fed is in a difficult position in some ways, and in an easy position in other ways. The easy part of it is the Fed responds to the data that they see. And when they're looking at the data right now, they see unemployment's low and stable, and inflation's too high relative to their mandate. And having cut 100 basis points over the course of the previous year, give or take, Typically in that scenario, the Fed would do nothing. And adding on top of it is some uncertainties around the tariff element of things, which could weaken growth, but also put more pressure on their inflation mandate. And that sort of is freezing them in place because they don't actually know exactly how the policy is going to play out. I mean, honestly, I wish I had a job where I could literally do nothing for a year, and that would be like, job well done, pat on the back. But that's basically what the Fed's position is right now, is to essentially do nothing until there's more clarity that things are going to move in one direction or another. One of the interesting things is, if you look at the market pricing, they are priced to cut between 2 and 3 times between now and the end of the year. That seems like an optimistic set of cuts in an environment where there is all this policy uncertainty. And therefore they might deliver a policy that is tighter than market expectations,
right,
which could be a drag on growth in equity prices ahead.
Is that your personal prediction? Is that they will cut less than is priced into the market?
Yeah, I think zero, again, a lot of range of plausible outcomes, but like no action by the Fed in 2025 seems like it would be my modal outcome in terms of what's going on. And you'd have to, and what I'd say is, in order to meet the 2 to 3 cuts, you're going to have to get a sharp slowing of economic conditions, which is definitely not priced into the equity market.
Right. So we obviously know so much about the markets. You were doing great work at Bridgewater, and now you have your own shop. So can you tell us, what is Unlimited? Why did you start it? What should our listeners know about it?
Yeah, I mean, Unlimited in many ways is the outcome of various things that we talked about in this conversation, which is, having been a 2 and 20 manager, both in the hedge fund space as well as running a $125 million venture fund that was sort of a systematic venture fund. I sort of increasingly recognize that a lot of 2 and 20 businesses are pretty good for the manager and not that great for the investor. And the reason why that is the fees are too high. For any taxable investor, almost all of them are structured in tax inefficient ways. And for a lot of investors, they're locked out of being able to access these sorts of returns because they're not accredited or qualified, et cetera. I mean, not to mention it's a hassle to do this, right? Anyone who's ever filled out fund docs or whatever, it's just a total pain, right? So even those people who are qualified to be able to do it, it's still a pain for them. And so that got me to thinking about whether there was a way to sort of create diversified low-cost indexing, which obviously totally changed stock and bond investing, but bring it to the world of 2 and 20. And I think, there's a lot of different strategies that are sort of access to alternatives. Most of those add to the feed load rather than, lessen the feed load. And investors need more access and lower fees, right? That's what they need. And so our idea was, instead of investing directly in the managers, what we do is we draw on our experience having, run hedge fund or venture, et cetera, money, and build financial products leveraging technology that allows us to look over the shoulder of what those managers are doing. And with that understanding, take it and translate it into long and short positions, for instance, in liquid securities that can back hedge fund strategy ETFs that can be made available for every investor. And the nice thing about having used technology instead of hiring, a bunch of star portfolio managers is we can do it at a much lower cost. And by putting in the ETF wrapper, it's liquid, it's transparent, it's easy to transact, and it's tax efficient. And so that's the core of what we are, which is developing these 2 and 20 strategies that are available for all investors at a low cost with daily liquidity and full transparency into what's going on. We started a few years ago and have a couple products in market. Our latest actually is a global macro strategy that is targeting equity-like returns, but with that global macro set of positioning, positioning based upon the 500 or so largest global macro managers in the world and how they're positioned in real time, put into an ETF wrapper, and that's HFGM for those who are interested.
What was it again?
HFGM, like hedge fund global macro.
Great. And what's your other product?
It's HFND, which is a diversified hedge fund strategy, kind of like the SPY for hedge funds.
Great. So kind of like QQQ or SPY, like you said, when you say for hedge funds, or you said earlier, looking over these hedge fund managers' shoulder, can you give some perspective as to what does that mean? And then how do you put that into your HFND, for example?
Yeah, so what we're able to do with our proprietary technology is to look at managers' returns in real time, and from that understanding, actually infer how they must be positioned. And for instance, for global macro managers, we see their returns in, we see daily returns and weekly and quite timely returns. We infer how they're positioned across the 30 largest liquid markets that they're typically exposed to. So things like currencies, credit, commodities, fixed income, equity indices, et cetera, and then express those views in terms of how they're positioned in real time in that ETF wrapper using futures. And so if you're an investor, what you see is an ETF that basically is the wisdom of the global macro hedge fund community. All you have to do is buy a single ticker, and you get all of that tactical trading under the hood, which we're managing, which we're understanding how they're positioned, and we're shifting the assets in the ETF to reflect that positioning as those macro managers shift their views over time.
Nice. So HFND is your original product. How long has that been around?
It's been around for about 3 years, and it's a multi-strategy product. So it was meant to track all the different hedge fund styles just combined together. And it's useful. It's a useful product for those looking for a very diversified hedge fund ETF, basically, right? If you have an ETF model portfolio, we're just looking for a diversified set of hedge fund strategies, it meets that bill. A lot of the feedback we got from advisors was a lot of them were interested in breaking out the individual strategies that sit under the HFND product. So like global macro or equity long short or managed futures, et cetera. And so that's what we're launching now. And we're doing that at a 2x target return, which in a lot of ways you can think about it like to match the expected return of equities or do better than that. And the nice thing about that is it's a much more cash efficient product with a higher target return. And so advisors really like those products because, if you have some equity long short managers that you like, you can keep those. But for instance, a lot of folks don't have access to global macro strategies. And so this is sort of a one-stop manager diversified solution for global macro strategies.
So I would have had to invest into Bridgewater or into Steve Cohen's fund or some of these other funds to try to get this really interesting stuff. I would be paying 2 and 20, but instead you're diversifying this and packaging it inside a public asset that I can just trade on, like Robinhood or Schwab or whatever, and it's HFND or HFGM. Is that right?
That's right. It's available on all the discount platforms. If you'd like to just go ahead and open your Robinhood and buy some HFGM right here, we'd be more than happy to do it.
Nice. And is there a minimum, or there's not a minimum
That is the beautiful thing about an ETF. And I see this every day because, I see the order flow. There are some people who come in, people, I don't know, follow me on Twitter and various social media platforms, and they'll buy one share, $25. Great. That's a great outcome, right? You can have a you can have a $1,000 account. You can have a $500 account and get access to institutional quality hedge fund strategies. Or, we have people who cut checks for $20 million. And that's okay too.
So they're charging the 2 and 20. What are you charging as part of your process inside of that $25 fee or the $25 price?
Yeah. So the management fee on the product is 95 basis points. And for our 2x target, so that's under 1%. And for our 2x target return ETFs, like the global macro strategy, that is essentially 1/8 of the fee load that you'd have in a typical hedge fund strategy. And it's because it's in the ETF wrapper, it's about half of the tax burden that you typically have investing in a hedge fund directly. And so 1/8 the fees and half the taxes is, we think, is like a very compelling proposition for a wide variety of investors, from the small investor to even institutional quality investors.
I mean, 1/8 of the fees and half the taxes sounds good for anybody, is what I think.
That's right. I mean, investors, all investors care about, and I think people lose sight of this. Investors just care about the net of fees, net of taxes outcome, right? Because the net of fees, net of taxes outcome is what you earn and what you keep. And so if you can opt to be cheaper in terms of the fees and you can have less taxes, that puts you in puts you ahead of the game in terms of what's going on.
And the first product's been around for 3 years. So can you share how it's performed versus the public markets?
Yeah, so hedge fund strategies in aggregate are generally more conservative than what you'd see in sort of, let's say, than equity risk. It's much more closer akin to the returns of bonds. And so they're intended to be diversifying to stocks in the same way bonds are intended to be diversifying to stocks for most allocators. And so it's returned, about 100 or 200 basis points above cash over the course of the last couple of years, which is basically what the strategy is intended to do, and it's tracked overall industry returns through that time frame. And I think what we're really excited about is these sort of 2x target return strategies, particularly the individual ones, which I think give investors a much more compelling return profile than sort of how hedge fund returns come out of the box.
When are you thinking to have the 2x strategies available? Meaning you're going to add more ticker symbols. Meaning number 3, 4, 5.
HFGM is the first of those tickers, the global
Okay.
macro strategy. In 6 weeks or so, we'll be launching an equity long short, as well as a managed futures, which is like a trend following strategy that that's become very popular. Also at that 2x target return. And through the end of the year, we'll be launching other strategies like fixed income, which is quite a compelling strategy from a risk return perspective, as well as event-driven or event-oriented strategies and hedge fund strategies in the emerging markets as well. So I think, a whole suite of different tools that you can bring to the table to think about to add to your diversified alpha portfolio.
Yeah, it's super interesting. When we were talking about your own net worth, you were saying how you don't really like to get into alternative investments, any liquids, and how you're really focused on public. But here you are getting into alternative assets, which are hedge funds. But the key here is you're figuring out how to jam it into a public vehicle to make it more liquid, hence making it more attractive. So I think you're straddling here and trying to innovate the world. So it's super, super interesting for sure.
Yeah, that's exactly right, which is in some ways, I mean, actually, when I started this work, what I looked at what are the assets, what are the returns that are the most diversifying returns for most investors. And, while there's so much energy being expended in private credit and private equity, those things economically are not that much different than public market equity or public market credit exposures. The things that are truly diversifying to a portfolio are gold, diversified commodities, and alpha strategies, long and short strategies like what we're talking about, but done at a much lower fee point. And so when I looked at that, I said the big gap in the market is the ability to access, you can go buy gold, you can go buy diversified commodities, but the big gap in the market is people can't access diversified hedge fund strategies at a low fee. And so that is exactly what that's why we built Unlimited.
Awesome. What's your favorite way to access gold? I
trade ETFs. I know there's some people who have a real focus on physicals, but there's lots of very reasonably priced ETFs in the market. The stuff's audited. It's sitting in warehouses.
Which ones do you like?
You can trade GLDM is a good one. IAU, they're all fine.
Perfect. And you're obviously a very smart guy, great, diverse background. What is it that you like to watch, listen to, read that helps you become who you are with this, curious / intellectual base making all these decisions?
Well, if I told you the Housewives franchise, would you laugh at me?
You're allowed to say anything you want. It's all good. You did start by saying you're professionally trained botanist, so it's all very interesting.
That is only kind of a joke. It's a guilty pleasure that my wife and I have that we watch those sorts of shows, and Bravo in general. But
nice.
Probably the more upscale things that I enjoy listening to or watching is I really like storytelling, like Snap Judgment type podcasts that I think are really kind of interesting, get into the mind of someone. I also still, with my sort of hard science background, I recently have gotten really into Science Versus, which takes on a lot of sort of commonly held beliefs through detailed, well-supported hard science. And it's a snappy, funny, gets to the heart of the matter. So they have things like, how marijuana affects you and whether there is a difference between the different strains and things like that. Or
nice.
all the way from that to how does coffee affect you and how much can you have a day, which is important because I drink a lot of coffee. So that's been helpful in me knowing how much I can go.
Any specific like investing or macro oriented pubs, newsletters, podcasts, content?
Yeah, I mean, I of course do this for a living, and so a lot of the stuff that I consume outside of this is sort of for my own interest. But when it comes to sort of the core macro stuff, there's so many good podcasts out there for macro. Forward Guidance is a great one. The Compounded Friends is really accessible and it's also like funny and interesting beyond just the sort of heart of macro, so I definitely recommend that. And so those are a couple that are sort of key to that I like to listen to on a regular basis.
Bob, we have covered a lot of information, everything from starting in the earlier days in Michigan farming town to getting into the hard sciences and obviously the botany, then going to Bridgewater and having such a diverse background. We are an alternative investment show, yet you started by saying pretty much that you're not into alternative investments and you love the public markets, which is awesome. That's why we have a diverse set of guests. You're 80% into the passive, the stocks, the bonds, the gold, commodities. You're 20% into the long, short, and other alpha-oriented things. You're not into Bitcoin. There's no convincing you right now, not because you hate it, but I wasn't able to convince you. You do think that bonds are more attractive than stocks today. You do think gold is attractive. You do think international is more attractive than the U.S. And there is potential recession, but it is dependent on where things land with the tariffs. If we are pricing in 2 to 3 times that the market's going to get cut for the rates, but you're thinking that potentially no action is going to happen in 2025. You started on Unlimited because of all this amazing experience and trying to get the 2 and 20 offerings at much more accessibility for much lower prices. You started out with your HFND product, and now you have your new HFGM product, which is accessing global markets. You've been around for a few years. You're offering 1/8 the fees and half the taxes, which is a great selling point for sure. And you're coming out with some 2x alpha strategies on top of that, whether it's the equity long short, the trend following, the fixed income, the events oriented. I love the fact that you share that you like Housewives franchise and you're into the Bravo stuff. But probably my favorite pick was your science versus content. That sounds amazing. I'm gonna have to check that out. Bob, thank you very much.
Wow, when you summarize it like that, we covered it all. Thank you so much for having me.
Have a good one.
Smart Humans with Slava Rubin is a podcast brought to you by the team at Vincent. Any data, text, or other content in this podcast is provided as general market information and not as investment advice. Past performance is not necessarily an indicator of future results. For more information on alternative investing, check out Vincent at www.withvincent.com.